Hey, y'all, and welcome to the CashFlow podcast, where we're going to talk about everything related to the money in your small business. I'm your host, Pam, and without further ado, we're going to jump right into our episode. Hey, and welcome back to our CashFlow series, 3 Things to Do. We're going to give you a scenario, and if you are this entrepreneur or this business owner, we're going to give you 3 things to do to deal with it. So, here we go. You're an entrepreneur looking at a profitable profit and loss statement, making money every month according to the P&L, but there's no cash in your bank, or your cash account is dwindling instead of increasing. What the heck is going on? Here are 3 things to do to figure that out. And essentially in this episode, it's 3 things to look at that are not on your profit and loss statement. So a little bit of background here is the profit and loss statement does a really good job of telling you what you're spending, what you're selling. What it doesn't necessarily tell you is how the cash is moving in your business. And that's why there's a very logical disconnect between the two. And from an entrepreneur or a business owner level, you don't really need to understand the details of it, but you need to understand 3 concepts. And that's what this 3 things to do is. So here we are again. Your profit and loss statement says you're making money, but your bank account is going down. Here are 3 things to do, 3 things to look at. The first one is something we call accounts receivable. So when you sell your product or your service, sometimes you sell it and you collect everything right away, in which case this is not even a section you need to listen to right now. So if you're on Stripe and somebody buys your product or your service, they pay you for 100% of it right out of the gate, you're not going to find anything here. But let's say you are somebody who has a payment plan for your product or service. So let's say that you have a coaching service and you're selling a group program and you allow somebody to pay you over 6 months. So say it's a $10,000 program and they're allowed to pay you, let's say 5 months to make the math easy. And they're allowed to pay you in 5 $2,000 installments. Okay, that's really cool. However, it's very possible that your profit and loss statement tells you you've sold $10,000 worth of business, which is 100% true. So when you look at your profit and loss statement, you see that $10,000 of revenue there. However, the reason your bank account differs is because you've only collected $2,000 of it. Next month, you will have collected $4,000 of it. The next month, you will have collected $6,000 of it. So although your profit and loss statement says, hey, we made $10,000, your bank account says, we only made 2. And both things are true. Okay, that's the hard part. Both things are true. So how do you want to look at this? The way I would look at it is always think about accounts receivable that is cash that just hasn't gotten to you yet. And one of the things you can do to accelerate getting cash into your bank account is to know very clearly at any point in time how much money people owe you. If your bookkeeping is being done for you in Xero or QuickBooks or FreshBooks, that's a very easy number to get if it's being done properly. And at any month, you will look at the end of the month, and instead of looking at just the profit and loss statement, you want to ask your bookkeeper for the balance sheet, and you want to see what that accounts receivable balance is. That number represents how much cash of yours is still waiting to come in, okay? And you can do a couple things with that, right? So say that you are in a cash crunch and you actually need to get some of that cash in the door earlier. One of the things that people will often do is say, hey, I am offering you a one-time discount on what you owe me if you want to pay me now. So say that this client example that we're talking about has 5 payments left or 4 payments left of $2,000. That's $8,000 we want to put in your pocket earlier in this example. So what we do very simply is say, hey, offering you a deal. If you want to pay me this now, I will give you a 15% discount on it. So that instead of paying me $2,000 a month for the next 4 months, you pay me $8,000 with 15% off right now in one check. And boom, you've just put all that revenue you see on your P&L in your bank account, which is what we're talking about here. Now, of course, you've had to pay for that. because you offered a payment plan. Now, let me dive into that for a minute because this is a little aside that I think is really important. When and if you offer a payment plan to people, you should always charge a little extra for that. Most people do this, but I think there are some who don't. So, say, for example, your program is a $10,000 program. I would say if you pay in one payment, it's $10,000. If you want a 6-month payment plan, it will cost you $12,000. So now you're picking up a little bit of extra money for how long that's going to be out of your pocket. And it gives you the room to offer that discount and still get as much as you would in the first place. So I hope that makes sense. If you're offering payment plans, the bottom line is always have it be a little more expensive than the one-time payment. So that's thing one. If your balance, if your bank account is not showing what you'd expect because of the profitable P&L you're seeing, the first thing you want to do is look at your accounts receivable balance on the balance sheet and know what makes it up. What customers are they that still owe you money and why? Here's the other little secret in this first one. A lot of times people don't pay attention to this number and it ends up people aren't paying them at all. And I can't tell you how many times I've come across this with new clients is not only is it the people who legitimately owe you money, but in a lot of cases, people who should have been paying you stopped paying a long time ago. And that's a problem because that is actually money that should be in your pocket already. And often that's the disconnect. So the one thing you want to look at here and insist that your bookkeeper gives you, if you find yourself in this situation, is you want to make absolutely sure you look at what's called, write this one down, an accounts receivable aging report. Sounds complicated, but all that's telling you is the money that people owe you current money that they owe you, like it's not overdue, or should this have been paid a long time ago and hasn't been paid? And you'll be able to see that very clearly and put an effort into collecting that money or stopping services for whoever that is that isn't paying. So that's thing one of 3 things to do. What's thing two? Thing two is called accounts payable. And this is another thing that doesn't show up on your profit and loss statement. So let's look at it this way. On your profit and loss statement, let's say that you have spent $5,000 to attend and sponsor an event like I'm at here today, Podcast Movement, and you've put it on your credit card. Okay. Here's the thing. You haven't actually spent the cash for that yet. So on your profit and loss statement, it definitely says, I have this expense of $5,000. But in this particular case, when you look at your bank account, you don't see that $5,000 gone, which is a good thing. And that's why I want to talk about accounts payable. Anything that you owe people, whether it's accounts payable or a credit card balance, is money that you're keeping in your bank account until you pay them. The reason this is so important to understand is a lot of businesses, especially as they start to grow, and especially when the owners are asking this kind of a question, is you'll find out that the people who are doing the transactions in the business aren't using credit cards. They're using debit cards, or they're sending ACHs from your checking account the minute a bill shows up. What you want to do is make sure that you know every expense that's leaving your business, particularly if you're in a cash crunch, and how long it is until you have to pay the cash for that expense. So here's an example. The same example. I knew that I was going to spend $5,000 to come sponsor Podcast Movement here, this fantastic event. But I also knew I didn't want to pay that any earlier than I had to. So I put it on a credit card. And that credit card didn't bill me for 30 days. So that's when I paid off the balance on that credit card 30 days later. And then the other thing this can do is give you some cash flow if you're in a crunch. So if you're in a cash flow crunch, you may not pay off that entire credit card balance. You might only pay off some of it. And then you get to float that money a little longer. Now, what's the price you pay for that? The price you pay for that is interest expense. But here's the thing. There are times when interest expense is an important number and you want to minimize it. There are times when cash flow is the more important number. So interest expense is the price you pay to manage that cash flow by delaying physically paying for things for as long as you can. This will happen sometimes when you're growing. So your expenses are a little more than normal. So you actually need to extend that payment time as long as you can. And this area of accounts payable and credit cards, this second thing to do is where you can start to manage that. First of all, make sure that your team is not at all ever just paying bills the minute they see them. Okay. That's thing number one here under this little subcategory. Make sure your team isn't paying any bills until they're due, and then determine whether you need them paying them on a credit card so that you can get some extended time to pay those bills, and possibly even not pay the whole credit card balance so that you can float it a little longer and not run into a flow crisis in your bank account. So I hope that makes sense. Bottom line on number 2 is know how much you owe people and make sure that you're not paying them any earlier than you need to. And when you're in a cash flow crunch, like you're growing or something has happened, COVID or a pandemic or something, and you really need access to your cash, make sure that you then may even roll a couple credit card balances. Now, this is just kind of level 1 stuff here, but ultimately what you want to do is get the lowest interest rate credit card or loan or credit line that you could. But quite honestly, the thing about banks is when you need the money, they're not going to give it to you. And when you don't need the money, they're going to give it to you. So a little side tip here, when things are going really well, get yourself access to some lower interest credit lines. Call your bank, whichever bank you have your checking account with, when things are going well, and say, hey, let me send you some financial reports. I want access to a credit line because I'm getting ready to grow and I want to invest in marketing or I want to invest in people. But here's a look at how well I'm doing. Can I borrow the money or can I have access to that credit line? That's just a little tip, just because lenders will give you money when you don't need it and they won't give you money when you do need it. Okay, so we've covered thing 1 and thing 2. What is thing 3? Thing 3 only matters if you happen to have inventory. So you're a product company, okay? And this is another place where what's happening on your profit and loss statement is going to be very different than what's happening in your bank account, potentially. And so why does that happen? Well, here's what happens. You often have to buy product a long time ahead of time or a short time ahead of time, but you have to have the product in house in order to sell it. So you will pay for product much earlier than when you'll collect money for having sold that product. And there are a few things at play here, but to kind of sum it up, what's happening is I have to pay, let's say I sell cocktail sauce. I sell cocktail sauce, I have it manufactured, and I know that I'm going to sell $10,000 worth of this next month. And I know that it takes my manufacturer a month to get me the stuff. So I have it in stock. So I have to potentially pay him a month ahead of time. And let's just say I pay him January 1st to get me $10,000 worth of cocktail sauce in my house at my table so that I can then sell it for $20,000. So even though I'm going to make money, and as I sell it, I'm going to get, twice the amount that I paid for this stuff, I've still had to put out $10,000 to get this stuff. Okay. And now I got to wait to get my $20,000 back. So that's why you might see something like, hey, I've sold all this stuff. But before that ever shows up on your P&L, your bank account's draining. And your bank account's draining because you had to pay to get the product into inventory. So the way to think about this is every dollar you've paid for inventory that's sitting in your storeroom or in your living room or whatever you're selling that hasn't been sold is actual cash you've already put out the door that you're not seeing as an expense on that profit and loss statement. You don't see it as expense on that profit and loss statement until you go and sell it. So that is one big disconnect. Now, this is most complicated of the 3 things to do, but for this third thing to do, what you want to do is understand what's called your cash cycle, and you want to write it down. And what you literally want to do is draw a timeline starting at point 0. Okay, so I hope you're with me, and I hope you're doing this while I'm talking to you. You start at 0. Day 0 is the left side of your timeline. And on day 0, you say, I order my product. And then whatever your payment terms are with that vendor, if he says you can order it and you got to give me a 10% deposit. So you write minus, and let's say we're ordering $10,000 worth of product. You have to give them a 10% deposit on day 0. So you put minus $1,000 right there above that line when you order the product. And let's say the rest of that money is due 30 days later when they ship it. So you go on your timeline 30 days out and you mark on day 30, product shipped, and you put a minus 9,000. So now on day 0, you had to put out $1,000. On day 30, you have to put out another $9,000. You are currently $10,000 in the hole, right? You need to be aware of that, especially when you're going to grow. You're going to double your customer base, triple your customer base. Be really aware that from 0 to day 30, all you're doing is putting money out. So know what that part of your cash cycle is. Then the next thing is, okay, how quickly do I sell it? And if you sell it right away and it's on your website and they pay 100% for it, you're collecting money on day 31. That's fantastic. But if, for example, you have to keep a good 30 days of inventory on hand, you might not actually get money out of that sale until another 30 days. So I would put on day, so on day 30, you're out now $10,000. Yeah, you're out $10,000. On day 60, you might start to collect money for that product you brought in. Okay, because until then, you've been selling product you already had in stock. So on day 60, you can put the plus 20,000 that you're going to get in. Okay, so now what you have is a timeline. On the left is on day 0, I put out $1,000. On day 30, I put out another $9,000. And then there's a 30-day wait until I get my $20,000 from my customers. It's a little complicated, but if you are a product business, you need to understand that cash cycle. You need to have this timeline for every SKU that you sell. Okay, just want to throw that out there. So here we are. You're an entrepreneur. Your P&L looks profitable, but your bank account looks nothing like you'd think it should if you were profitable. What are the 3 things to do? Number 1, look at your accounts receivable balance and see if you want to collect that money any faster and make sure everybody's paying you. Number 2, look at your accounts payable and your credit card balances. And if you're in a cash crunch or you're trying to grow, make sure that you're paying those as slowly as you can and accept the fact that interest is a cost of growth. And the third thing is look at your inventory, and for every SKU that you sell, know what your cash cycle is. When do you pay your vendor? When do you collect cash from your customer? That'll get you through it. And those 3 things explain most of the difference between your profitable business and your bank balance. Have a great day.
I hope that video was helpful, and I hope you subscribe to my channel for more information on finances in your business.